Hi, this is Joseph Viery from USTAGI, U.S. Tax Advisors Group Incorporated. If you want to learn how to use your small axe to build an empire, you should be listening to the Small Axe Podcast with my good friend, Nico.
Hey guys, it's your boy Nico here from the Small Axe Podcast. I want to show you how to use your small axe to build a lasting empire. You see, not everybody begins their investing career with millions of dollars, a huge network of investors, or the knowledge necessary to become successful in this space, and that's okay. What I focus on here on this podcast is helping you hone your skills, sharpen your tools to become the best investor that you can be. Now, I want you to sit back, relax, and enjoy this show. If you have any questions or you want to reach out to me or the guest, feel free to do so. Love you guys. Hey, Small Axe community, it's Nico. Today I'm hanging out with a guy named Joe Viery. I met Joe on the internet like I meet a lot of people, and he's got a really cool expertise that I think is pertinent to us as real estate investors. And I'm going to have him talk a little bit about what he does, how he can save people a lot of money in taxes, how he focuses on helping others, just build their portfolio, build their long-term wealth and generational wealth. So without further ado, let's get Joe on the show. Joe, what's up, man?
Hey, Nico, thanks for having me. Not too much. How are you?
I'm doing great, man. It's a beautiful day out here in New York. You're over on the other side of the world, and just glad to be connected with you. And let's talk a little bit about your background, where you come from, and how you got to where you are today.
Very good. So I have a little bit of a different background. I've always been entrepreneurial. And when I was in college, there was I went to Europe when I was in high school. Then I'm in college and I was going through campus and there was a travel day. And I stopped and asked the guy who helped me go to Europe. We talked about travel and I asked him if he needed help and he said, yes, come talk to me. So I worked for him as a travel agent. That wasn't really what I like to do. So my manager told me about group travel. So that piqued me up. And I said, what do you have to do? She goes, you have to sell a couple groups. So I sold a couple groups and I went on the road and I came back loving going on the road. So then I segued into becoming a full-time tour manager. And because that took a lot of time away from my relationships, I was working 6 weeks, traveling, and then 1 week home. That didn't work out. So I said, what am I going to do now? And I started my own business. So I worked as a tour operator, special interest tour operator for 20 years. In 2000, I sold my business and I worked for the California Association of Realtors. And I was helping them with financial planning. I was securities licensed, financial planning and taxation issues, both for the members of the CAR, California Association of Realtors, and then of course their clients. And then something happened in 2007 and 8, which impacted the California Association of Realtors. The car was driving nice, and then all of a sudden it went off the cliff because we had a little depression, recession, whatever you want to call it. And prior to that, I had a guy kept wanting to talk to me about a taxation strategy. And I thought he wanted to sell me something. I kept blowing him off. Finally, I said, okay, Mike, let's go and have lunch. We had lunch. He told me about cost segregation. I said, what's that? He explained it to me. And I had two clients who sold properties and they owed the IRS over $50,000 and they didn't have the money. I told them about this strategy. I put them into it successfully and, they were thrilled. And then the car went over the cliff and the California Association of Realtors and all the real estate industry in California screeched to a complete halt. Well, the guy that I did that cost segregation studies for, he called me up and said, why don't you come work for me? He goes, you're good at what you do. You know this stuff. So I segued and I went into the cost segregation industry. That was in 2007. And I worked for a couple companies. And then about 7-8 years ago, I started U.S. Tax Advisors Group, which is my own firm. And so I own the company now. We're nationwide. And what we specialize in is what cost segregation does for those who own investment real estate, not your primary residence, but investment real estate, we reduce or eliminate their income taxes. So if you're a tax-paying real estate investor, you want to talk to me, because what we do is we accelerate the depreciation expense, which in essence eliminates or reduces income tax.
Wow, Joe, great background, man. Great story there and great journey. Thank you for sharing all that.
You're welcome.
So you specialize in helping people reduce their tax liability or eradicate it, what you're saying. Are there specific strategies that you use to help do that? And I'm sure that there are a variety of, things that you come up against with each individual person having a different story. So what are some of the main strategies that you use?
Well, number one, it's the acceleration of depreciation. And let's be very, very clear, because I don't want this to go in a different direction. This is income tax, personal income tax, state sometimes, and then federal all the time, 100%. Why I say state sometimes, because states have different laws than the federal. Some of them copy the federal law, some of them don't. Like California doesn't recognize cost segregation or accelerated depreciation, which doesn't really impact my business. But it's basically for sure for federal income tax. When you buy a property, you're either a passive investor or an active investor. If you're a passive investor, that means you have a job and you're getting your income from another source, and you're just investing in real estate. So let's just take the doctor example. There's a doctor, a physician, he makes physician income, and that's his primary income. And then he invests in real estate. And so if you're a passive investor, there are limitations to the amount of depreciation expense that you can take. So if you're a passive investor, you can still utilize cost segregation, but it's not as great as if you're an active investor. If you're an active investor, all that means is you're at least spending 750 hours per year on your real estate. So even if you have another source of income and you're still spending 750 hours per year, which isn't that much, breaking down weekly, you could still be considered active, and you could still use my deductions as an active expense. So to explain what depreciation is, I'll make it really simple. I'm not an accountant. I'm not an attorney, so I'm not going to give you tax or legal advice. But what I'm going to tell you is this, is that basically the IRS recognizes that your building is being used up or, used up throughout time. So a lot of times, throughout the time, it doesn't mean that you have an expense necessarily. Let's say the roof. It's just your roof is degrading, and then maybe 5 years after ownership, you pull the plug and you put the new roof on. Well, the IRS says, look, we're going to give you this concept where you can take the building basis of your acquisition. So you buy a building for $1.2 million, and let's say you designate $200,000 for land. Land is not depreciable, so now you have $1 million building basis. So the IRS says, okay, if it's a residential property, divide by 27.5 years, and that's your depreciation expense. If it's a commercial property, divide by 39 years. Well, you can tell, you just get a little sliver of that depreciation expense. If you divide that by 40 years, it's not a very big expense. But now here comes the part that everybody can understand. If you're in a multifamily, an apartment complex, or you're in a hotel, and I point down at the carpet and I say, well, that carpet lasts 27.5 years or 39 years, you're going to say, heck no, it's not going to last. It's going to last 5 years if I'm lucky. And so the IRS has hundreds and hundreds of components of the building that you can put into shorter lives. Carpet is a 5-year property. And land improvements is a 15-year property. So the job of the cost segregation firm is to go and look at your building, either via satellite technology or in person. And what we do is we break out all of the shorter life assets. Carpet's 5 years, land improvements like fences and swimming pools and patios and driveways and lighting is 15 years. And then you're always going to have the 39 or 27.5 year property. So we peel off, I'm just a very rough number, let's say 30%. So we'll find about 30% that can be in shorter lives. And right now we're into bonus depreciation. And what the Trump tax law did a couple of years ago is they said any life of the building, which is 20 years or less, can be immediately expensed after you do a cost segregation study. Now, the reason why you have to do a cost segregation study is that an accountant or the building owner is not going to know which are legitimate, building components they can put in shorter lives. We do. So that's what we break out. We break out, remember, the 5-year, the 15-year, which is going to be a bonus depreciation. So the last year for 100% bonus was in 2022. This year, for a building bought in 23, when you file your taxes next year for the 23 tax year, it drops down to 80%. So what that means is if you're on extension, it's 100% of what we find in the shorter life, you get to expense immediately in the year that you file that tax return, which would be for 22. And so if I find 30%, you can get the math. 30% of $1 million, I'm going to give the owner of that building a whopping $300,000 deduction against their taxable income. So if you have taxable income of whatever it is, and then I give you, let's say it's $100,000, and I give you a $300,000 expense, guess what? You're not going to owe any money because the $300,000 is going to wipe out that $100,000 of taxable income. And that's the value of what we do.
Excellent, Joe. Thank you so much. And now let's take, so we just used, we had $100,000 in income. We got $300,000 in this write-off. Does that carry forward?
Yes. And that's a great question, Nico, because all our losses carry forward until you use the bucket up. Now, you can't stage the losses, though. You can't say, oh, I'm only going to use $50,000 this year. No, you've got to take it all to wipe out your taxes. But the good news is it'll carry forward until you use that bucket up. So there's really no reason not to take this extra depreciation unless you're a flipper or you're going to sell the building within 2 years of acquisition. If you're going to sell the building within 2 years, I would tell you don't do it, because there's a concept called depreciation recapture, and it's a tax that they tax the depreciation you took. And so, really, if you're going to be a flipper and you're going to sell it immediately, I would say don't bother giving me any money to accelerate your depreciation, because you'll still have an advantage, but it's not going to be as great as if you hold the property for, like, let's say over 2 years, 3 years, 4 years, 5 years, or greater. Then that's the real value of cost segregation.
Excellent. Joe, is there, so let's say 5 years, because the typical syndication is 5, 7-ish years, or we project that, right? Is there still value in it then?
Oh, it's great value. It's great value. And here's the one thing, as I told you about depreciation recapture, and I'm going to give you a highbrow example of how cost segregation reduces depreciation recapture. Now, if you only hold it for a year, for less than 2 years, you're still going to feel the effects of cost segregation. So I would say don't do it. But if you're going to hold it for 5 years, here's the theory. I've identified the 5-year property. So what happens when you buy a laptop that's you bought it 5 years ago, you bought it for $2,000. What's that laptop worth today?
$200.
Maybe for parts. If you're lucky to find somebody that can give you $200. So my savvy accountants tell the IRS, look, I know what the 5-year property is because Joe already peeled it off. I know what it is. And guess what? It's 5 years down the road. So my 5-year property is the $200 laptop example. It's got some residual value, but not a lot of residual value. So who comes up with that amount? That's between the property owner and the accountant. And you're going to have to come up with some meaningful or meaningless cost. And the 15-year, it's going to be 1/3. So all your 5-year property is going to be taken off the table for depreciation recapture. All of the 15-year are 2/3 or 1/3 of the 15-year property is going to come off the top. So what have I done? I've just reduced your depreciation recapture by following the rules of accelerated depreciation. So if you're in a syndication and you're going to plan on holding it for at least 5 to 7 years, it's well worth it.
Excellent. Before I move on from this topic, or this where we are right now, I have another question. So is there a certain building size or dollar value size of acquisition size or amount that it doesn't make sense to do a cost segregation study?
That is a great question. I've been doing this for so long that back in the dark days, yes, there was. If you had a building like you could buy single family homes for $25,000 back in the day, a long time ago, yeah, it wouldn't be worth it. But we've developed a new type of technique, which is still approved by the IRS, which allows us to do an analytical study, which means I don't have to fly to the building. Now, what's the caveat? It means if your building basis is $750,000 or less, we can do the analytical or modeling study on that building. I'm not going to fly to that building. I'm going to do it all of it analytically, and I'm going to do it all by our satellite technology. And so that dropped the price down to hundreds of dollars. So I can model any type of building, but let's say single family home that has a building basis of 750 or less. I can model it, and the fees are, like I said, are hundreds of dollars. If you have a building that's larger than that in basis, I will have to still fly out to the building and measure it. Those full cost seg studies, not the modeling study, are going to be thousands of dollars. I think our minimum fee for a cost seg study that we can't model is going to be closer to $4,000. So what that did is that opened up to the public. Anybody, single family home, smaller condo owners, small, commercial buildings like, a doctor's office, or, any type of a small building. Basically, now we can model it, and you can still get the accelerated depreciation. And we're one of the few in the country that do the modeling technique, and we do all the work. Some of my competitors make the clients get online and do all the work, and it takes them hours to put in all the work. My engineers do all the work. We just need to get some basic information from the owner, and then we can model it. So that's a great question. So there is no minimum nowadays, because the $25,000 single family home, that is gone. And so now you're probably talking a minimum single family home, maybe for 50,000 if you can find one. So I can do 50,000 and make the numbers work. So basically there is no minimum. And as far as maximum goes, I've done a $500 million project. It was a building in downtown Union Square, San Francisco. So bottom line is I can do any building, whether it's a hotel for $25 million or whether it's a single family home that you paid $150,000 for, I can still find value.
Awesome, Joe. You mentioned in there that you did one in San Francisco. Did you just say?
Yes.
500 million now? But you also mentioned in the beginning that something about California doesn't recognize depreciation, or maybe you can kind of reiterate that and kind of clarify or help me understand a little bit better.
Yeah, well, here's the deal. If you're talking in California, combined income tax rate of 45, which is going to be the owner of that building is going to be a 45% combined state and federal. Well, guess what? Our state tax is 13%. So take 13% and peel that off and throw that away. So bottom line is I'm still giving the owner 33,000 or 33% that they can use against their federal income taxes. So that's why people in California still do cost seg, because we're not like Texas and Florida where there's zero income tax. We pay a lot of income tax, and who cares? You just can't use my findings for people who live in California, but it's still a fat number that you're still going to want to accelerate depreciation.
Got it. Perfect. Thank you for clarifying. That helps me out. Joe, I got another question. So what is so you also mentioned in the beginning, you were talking about you can't use it for this is investment property only. Is that correct?
Correct.
All right. So single family home can obviously be investment property, but what is the most common, I guess, asset type that you're working with?
You know what? Because we're doing the analytical and we have few competition, we do a lot of single family homes, smaller buildings. We'd still do a lot of the bigger buildings, but I would say single family homes for modeling, number one. And then I would say multifamily. And then then another mishmash of groups. So multifamily number one in the full detailed engineering study. And then in addition to that, we do a lot of hotels, we do a lot of senior centers, and we do a lot of shopping centers. Now, we can do any type of building, but those are the ones with that it seems like most people invest in, those four classes: multifamily, hotels, single family, and retail shopping centers.
Excellent. And I think you kind of alluded to also in the beginning, Is like real estate professional status. Is that what you were alluding to with being active as an investor?
Yes.
Can you explain a little bit more about that? Because I get this question all the time, and I don't know how
Yes.
to explain it.
Well, it's simple. Here's what happened. And I think if you have the example of what happened, then you can kind of put the dots together. Basically, in the 80s, doctors had a great income. They were making great. That was a long time ago. They were making, a lot of salary. And so what they were doing is they were going out and they were buying these dilapidated buildings just to get the depreciation expense. So Congress got wind of it and they said, no, 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 no. You're a doctor. You have doctor income. You're a passive investor. And so we're going to limit the passive investors' depreciation you can take each year. Now, again, I don't know. It's different for everybody, but it's limited. I think you can take anywhere from 25 to 40% of the depreciation we find. That's the maximum depreciation expense you can get per year, but you have to check with your accountant. And we do a no-cost estimate. So we'll give you the estimate. You take it back to your accountant and say, is it worth it? If your accountant says, no, it's not worth it, I don't think you should do this, then I'll agree with your accountant and you don't do it. So basically, you have passive investors. Now, what's an active investor? Well, that's kind of obvious. An active investor is somebody who works in the real estate industry and their income is coming from real estate. So if you're an active investor, the IRS definition, and keep in mind, it's not a bright line, it's a murky line, but basically here's what they say. If you if you spend 750 hours per year on your real estate, you can be an active investor. Well, a lot of people can do that because every time you discuss, you think about, you read a book, you read a magazine, you go on a podcast for real estate, guess what? Put it in your log. 1 hour listening to Joe talk about cost segregation. And as long as you can document 750 hours, you're going to become active. The value of active means if you're an active investor, the amount of depreciation expense I give you can be used against all of your income, not your property, any type of taxable income, that expense. So it's really valuable if you can be a real estate professional. Now, what some of my clients do if they're married and they file jointly is they then have their wife become the real estate professional. They still have the job as an engineer, and then they have their wife is the one who manages the real estate. She becomes the real estate professional. Now all of my losses are active. So that is a very important strategy for anybody that files a joint tax return. The other weird little caveat that happened here is if you're in a short-term rental. Okay, what's a short-term rental? That's an Airbnb. Airbnb short-term rentals are considered hotels. They are 39-year property. And they dropped the hours from 750 to 500 hours if you own an Airbnb. So just keep that in your back pocket, knowing that it's a different categorization. So now you're only liable to do 500 hours, per year. And if you own 3 or 4 Airbnbs, it's going to be pretty easy to get to 500 hours.
Yeah, absolutely. Thank you, Joe.
Yep.
Really, really great synopsis and clarification there. So my other question then is, since I do syndications, I actively manage the portfolio, right? But then we have the limited partners that are passive, and some losses get passed through to them. Is that true, or how does it work with the cost seg study? Or
no, it's exactly true. So what happens with depreciation or losses, if you want to use that term, I use it too. It's basically a function of what you own, the percentage you own in the property. So if I gave your entity $300,000 in losses and you're the general at a 50%, you're going to carve out $150,000, and the rest of the $150,000 is going to be distributed by how much they own of the property. So if you have an investor that owns 1%, they're going to get 1% of the $150,000. And for the investors, it's not a bad deal. It's not a huge number, but still, I mean, any dime or quarter you can save or dollar you can save is still worth it. I mean, you're never going to go wrong with it, but it is true that once you get into these small syndication percentages, yeah, you're still going to get the value.
Awesome. Thank you, Joe.
Oh,
All right,
one other thing too. is you can't trade your value in a syndication or a partnership. You can't trade it. So if you don't need it, like I have a lot of industrial developers, and their money comes from Wall Street. And guess where their money comes from? Insurance companies. And guess what? Insurance companies don't pay income tax, so they could care less about cost segregation. So you cannot, the Wall Street money can't give you their losses. If they have $50,000 of losses, they have to take the $50,000 of losses, whether they can use them or not. And that's kind of unfortunate, but that's the way it works. Whoever owns the percentage of real estate must take the accelerated depreciation. And if they can't use it, too bad.
Wow, interesting stuff, Joe. Thank you so much.
Yep.
Let's talk a little bit. We are getting kind of short on time. Let's talk a little bit about logistics. So I just bought a property, let's say, or I got a property in the contract. When do I call you? How does the process work?
You know what? Call me as soon as possible, because we do the no cost estimate, and we have a link, which is on USTAGI.com, U.S. Tax Advisors Group Incorporated, USTAGI.com, and you fill out a form. If you have a portfolio, then you can just put the information on our portfolio link. And then it comes back to us, and we'll turn it around and give you an estimate. So the first step is to get an estimate for me, because then if I can answer the questions, great. If not, I'll tell you, take the estimate to your accountant and ask them, and whatever they say, I agree with 100%. If they say you're not a good candidate, great. I will maybe give you my viewpoint. So bottom line is, fill out that form. If it's a look back study, and by the way, we can go back 15 years and make it work. So if you bought a property in 2010, don't think you can't take advantage of it. It's a little bit more complicated. We charge a little bit higher fee because we have to do calculations that show the IRS how much depreciation you've taken, what's the new bump in depreciation from accelerating it. So we have to calculate all those numbers. And so the fee's a little bit higher because we have to do the calculations. But bottom line is, if you do have a look back study, and for this extended 2022 tax year, I'm referring to any property that was bought in 21 or previous, you have what's called a depreciation schedule. That tells me everything I need to know. If it's a look back study, send me your federal tax depreciation schedule and the address, done. If it's a 22 acquisition, you're not going to have your depreciation schedule unless your accountant is Superman. And so then what you'll do is fill out that form and just give me the basic information. How much did you pay? When was it closed? And the date that it closed. And basically we can run the estimate on the information you give us. And then you take it to your accountant and ask them, is this worthwhile?
Excellent, Joe. So what I'm gathering is reach out to you now, regardless of whether you have a deal or not, or you have closed a deal in the past or not, right? So because you can do look back studies, you're saying you can build the relationship and just kind of get to know somebody to see if you guys would be a good fit to work together, or if you have something in contract, go for it. Yep. and get that free analysis done.
That's my recommendation. Get that before we can talk, because until I know the numbers, I can't really evaluate the property. And the way that we do the estimates is we do look at the property. So I need the address. So I will go online and I'll look at the address online, all the information. The client doesn't need to give me the information. I'll look at the property and figure out what it is, because our fees are based on engineering time. So I need to know, like, I'm looking at a property now, which is like a 25 tenant shopping center. Well, that 25 tenant shopping center is not going to be the same price as a medical building that's only, like 3,000 square feet, because the shopping centers take a lot of time.
Makes sense. Excellent.
If you want to do a look back study, meaning 2022, go back 3 years, it's $2,000 per door. And basically there are standards set by the 2006 standards. And they're saying if you did the work on your building and you increase the energy efficiency of the building by over 50% above those standards, then you can qualify for the $2,000 per door tax credit. A tax credit is not depreciation. A tax credit comes right off your tax bill. If you owe $100,000 and I give you a $2,000 tax credit, you owe $98,000. So it's really is powerful. Now, how do you know if you qualify? Well, that's a little bit more difficult. It's a combination of energy efficiencies in the building. So what are the most common? Of course, HVAC, heaters, water heaters, lighting, insulation, roofing, windows, doors. And so it's a combination. So I can't really give you a quick overview, but I can tell you that if you get our form and you let us know what you did to improve the energy efficiency of the building, then we will let you know whether you're going to qualify or not. So it does take a little bit of work, because, you know, if you don't know the R rating for your insulation, you're going to have to find out. Because, you know, if your insulation is not energy efficient, you know, you're not going to qualify, and we're going to tell you we're not going to take money from you unless you qualify. So you're going to have to fill out the form, and then going forward, it's a little bit more different. I'm not going to get into it, but the good news is it increases from 2,500 to 5,000. Different
Wow.
rules of the game, and I'm not going to get into them. I need my energy engineer to talk to you about it, because, you know, it's still a lot of moving parts, but it's even more valuable. So if you're any type of value add client, you should definitely look at energy studies, and it's on my website, ustagi.com.
Oh, we're going to do it. I'm going to reach out to you right after this. I'm going to have my partner reach out to you. Now, when you talk about a tax credit, is it a one-time thing?
Yes. Well, I mean, it may not be, but I've never had anybody who was able to do it twice. So, you know, as long as you increase the energy efficiency, but once, let's say you go in and you put a new HVAC, new water heater, and new lighting in, it's going to be pretty hard, just what's left over, doors, windows, and insulation, to get another tax credit. So I would consider it more of one and done.
Oh man, this is actually really exciting, Joe.
Yeah. And if you sold the property 3 years ago, as long as you did the work, you can still go and get the tax credit.
Oh, this is huge. And is the cost for you to do this similar to the cost segregation study, or how does that work?
Similar to the modeling study. We charge, I think it's $575 per door to do the tax credit. So it just depends. I would just use 500 as a general fee, but for $500, you're going to get an IRS compliant study, which we will defend, by the way, all of our work, you know, cost seg and energy studies, we defend it at no extra cost. So you'll get a certificate for the energy study that you're going to be able to use and file in your taxes.
And similar to like the introduction, or I guess a preliminary analysis, is there like let's say we sent you X, or we filled out the form on your website, and you could tell us yes or no, we should go for this. Like yes or no, yeah. It'll be worth it for us to pursue.
Yeah,
awesome.
Yeah. We don't charge for that either. We will, you know, but unfortunately, it's not like cost seg, which is really super easy. There's only a couple questions. You have to answer questions. I just named them. You're going to have to tell us, okay, what kind of lights did you put in it? You can't just say, oh yeah, I did the lights. No, we got to know. What did you do? You put in LED. Who's the manufacturer? You put in a new water heater. Okay, is it gas? Is it electric? You know, what kind of water heater? What's the model number? What's the name of the manufacturer? You did an HVAC system? Same thing. How many SEERs is it? What's the manufacturer? If you're very frugal when you do your renovations, then you're probably not going to qualify. So if you put in a new HVAC system and you put in a 13 SEER, probably not going to qualify. You need to really increase the energy efficiency. So you're at least going to have to do a 14 SEER AC. So it just depends, because most items that you buy nowadays are energy efficiency. It just depends on a lot of factors. So it's not as easy as an answer as cost seg.
Yeah, no, I get it. Now, is there some sort of list that we can kind of look at to see? Because I know you mentioned some items, you talked about the major items that we can do, but is there a list that we can find somewhere?
You know what? Let me email you the list. Yeah, I just named them. It's pretty relatively simple. It's doors, windows, the building envelope. Doors, windows. It's the roof. It's the insulation. It's the HVAC, the water heater, the heater, and all the electrical. Oh, and the appliances too. All the electrical fixtures and the appliances. That's the list. So it's relatively easy. So, you know, if you, in a lot of value add clients, they do everything. they go in and they put in new doors, new windows, maybe not a new roof, but maybe new insulation, which is not critical if you don't do the insulation or the roof, but then you'll pick it up if you did replace the HVAC and you did a 14 SEER HVAC.
Excellent.
Yep.
Got it, Joe. All right. Well, thank you so much, man. This has been like game changer for me, and I'm excited to kind of move forward with this. So I'm going to ping my buddy right now, my partner who's all over this, our CapEx plan.
Great.
We're going to get in touch with you.
And then here's the deal. You want to get talking to my engineer before you start doing your CapEx plan, because we'll tell you what you need to do. Like, in other words, if you're going to, I'm going to buy a 13 SEER HVAC, we're going to say, well, it only costs $150 more to buy a 14 SEER. And you're going to get a $5,000 tax credit. So duh. And we're going to tell you what to do. If you say, I'm going to put this kind of a water heater in, we're going to tell you, well, yeah, you can do that. But if you spend a little bit more, this water heater is the one you want to put in. And so we do that consultation at no charge.
Okay, Joe. So let's do this. I'm going to pose my final question, and then we're going to get some form of reaching out to you because the listeners are going to need to follow up with you. So here we go. Let's imagine it was 100 years from now. You have great grandchildren or heirs or relatives running around, and they're as happy as can be. And they wanted to write a book about you. And what would you want them to title this book? Or what kind of characteristical traits about yourself would you want them to highlight about you?
I think the most important thing is, would I be the grandfather or great grandfather?
I think you're going to be a great grandfather.
Okay. My great grandfather was able to save hundreds of thousands of people cash flow, which enabled them to produce wealth in real estate. And there are very few people out there that do what I do. That's why I love doing what I do, because I make a difference. I can save somebody who owns a small building $50,000, and I want them to use that $50,000, go out and buy more real estate.
Oh man, Joe, I love that. And here's a strategy that we've used. Some of my partners will actually show their K1s to their investors to show them exactly what they're going to be, kind of like a sample of what they can expect as new investors. And it's truly, truly helped a lot of people out. So I appreciate what you do, man. Let's get the listeners some form of contacting you.
I think the easiest way is this is my website. Again, it's U.S. Tax Advisors Group Incorporated, or USTAGI, US TAGI, if you want, USTAGI. And you go online and you're going to find the part of the website that'll take you to filling out the form where we get some information, and then we'll turn it around and get back to you. And then if you want a discussion, I think one of the differences between my company and others is that we're very accessible. If somebody wants to talk to me, pick up the phone, or not pick up the phone, but you have to schedule a call with me. Schedule a call with me, and I will go over with you and tell you whether I think you're a good candidate or not. If you're not a good candidate, I will tell you you're not a good candidate. I don't want your money if you're not a good candidate.
Excellent. Okay, Joe. It's been an honor talking to you today. I really learned a lot. You enlightened me a lot about cost segregation study and just so many different aspects of it and how it works. I'm ready to rock and roll. I just got to get another property, and we're going to be talking in the near future.
Excellent.
So thank you so much, man.
Thank you, Nico. Good job. Appreciate you.
All right. Hey, Small Axe community. I would like to say thank you for listening to another episode of my podcast, where we show you how to use your small axe to build a lasting empire. Now, if you liked what you heard, it would mean the world to me if you would subscribe, leave a 5-star rating, and write a review. Also, if you want to get in touch with me, go to my website at smalaxecommunities.com. Book a call with me. And until the next episode, keep sharpening those axes.